What affects conventional mortgage rates and how are they calculated? It's a question we commonly get, and most consumers and even realtors don't know. In this video, we'll look at 4 factors that affect mortgage rates. Those would be discount points and origination fees, loan level price adjusters, the overall state of the economy, and the lender's profit margin. All of these factors are taken into account by lenders when determining the interest rate for a conventional conforming loan. Factor number 1 is discount points and origination fees. What many lenders fail to explain is that there are often multiple mortgage rates available on a given day for most every loan type. The mortgage rates available on a given day function much like a sliding scale between discount points, commonly called points, and lender credits. Generally, points and lender credits let you make trade-offs in how you pay for your mortgage and closing cost. Paying points lowers your interest rate, and therefore your lower monthly payment, in exchange for you paying a larger upfront fee. Alternatively, lender credits lower your closing cost in exchange for you accepting a higher interest rate and therefore a higher monthly payment. The greater the net points paid, the lower the principal and interest payment and the higher the estimated cash to close. Conversely, the greater the lender credit, the higher the principal and interest payment and the lower the estimated cash to close. These terms can sometimes be used to mean other things. Points is a term that mortgage lenders have used for many, many years. Some lenders use the term points to refer to any upfront fee that is either 1, calculated as a percentage of your loan amount, or 2, a flat fee charged by the lender. Some lenders will call this flat fee a loan origination fee. When comparing lenders, if lender A is not charging a loan origination fee, but lender B is charging a loan origination fee, your comparison of loan terms is not equal. This is because lender B is charging more fees than lender A, who offers the same interest rate. In the example on your screen, lender A does not charge a loan origination fee and offers a note rate of 5.851%. There's no discount points and no lender credit. If all else is equal, and lender B offers the same 5.851% rate, but does charge a $715.91 loan origination fee, that same $715.91 origination fee, if paid to lender A, would ultimately get a lower rate. So, lender A could either match the note rate of 5.851%, but have $715.91 less in fees at closing, or lender A could charge the same amount of origination fee that lender B is charging, but offer a lower interest rate to the borrower. Factor number 3 is what are called loan level price adjusters. I'll give you some background here. During the Great Recession of 2008, thousands and thousands of mortgages went into default, causing a massive housing crisis and collapsing financial markets not only here but around the world. The government-sponsored enterprises of Fannie Mae and Freddie Mac recognized that they needed to cushion themselves from losses moving forward and created this term called loan level price adjusters. We're going to call it LLPAs moving forward. LLPAs allowed Fannie and Freddie to assess greater fees on loans that presented greater risk. Rather than assess an across-the-board increase in fees on all conventional mortgages, Fannie and Freddie elected to keep fees lower on less risky loans while assessing higher fees on higher risk loans. These fees are directly assessed by Fannie and Freddie when the lenders will sell those loans into the secondary market. Now, in order for LLPA pricing structure to take place, the lender first must assess a borrower's risk. To assess the borrower's risk, there are certain risk factors that the lender is going to look for, and those LLPAs are cumulative as well, meaning if you trigger 4 different LLPAs, all 4 of them are calculated together cumulatively. The primary risk characteristics that trigger LLPAs include but are not limited to credit score, the higher the better, Loan term, the shorter the better. Occupancy types such as owner-occupied, second homes, vacation homes, investment properties. The number of units in the home. Subordinate financing. Are there any second mortgages? The loan purpose. Is it a purchase? Is it a refinance that's rate term, or is it cash out? The property type. Is it a condominium? Is it a manufactured home? Is it a site-built home? What is the debt-to-income ratio? Meaning, what is the ratio of monthly debt payments relative to income used to qualify the loan? What is the ratio of loan amount relative to the value of the property? Is the repayment fixed, or is it variable or adjustable? Those are some different factors. The price of any particular mortgage loan dictates what the interest rate will be for that loan. The higher risk, the higher the price, meaning the borrower is going to have to pay either a higher interest rate or more discount points. And the lower the price, meaning the lower the risk, means the borrower will have to pay a lower interest rate or lesser discount points. The LLPA system contains more than a dozen different risk characteristics. Nearly all conventional borrowers are affected by at least one LLPA, though there are a few scenarios which completely avoid LLPAs. One such scenario would be a borrower with a credit score of 740 purchasing a single-family detached home as their primary residence with a down payment of 40% or more and no second mortgages, and their debt ratio is below 40%. The overwhelming majority of borrowers who choose conventional financing will have to deal with at least one or more LLPAs. These adjustments aren't as simple as fees added to your mortgage either. While it may appear that LLPA fees are directly charged to borrowers on their home loans, the actual process is slightly more complex. What truly occurs is that when LLPAs are imposed, the secondary market reduces, and in some cases even eliminates, the amount of compensation they provide to the lenders who originated those loans. The inflated costs that borrowers are left with are a way for those originating lenders to recoup the loss of compensation. Another way of looking at it is that LLPAs are the deductions to the fees lenders receive that are paid for by borrowers through either higher interest rate or payment of discount points and origination fees. LLPAs are unique to conventional Fannie Mae, Freddie Mac loans. They do not apply to government loans like FHA, VA, and USDA, although FHA, USDA, and VA loans do require the property be owner-occupied. Now, the third risk factor is the monetary condition of the economy. Financial markets can affect mortgage rates in a number of ways. Long-term mortgage rates are determined by the yield on mortgage bonds. When mortgage bond yields are low, mortgage rates are low. When mortgage bond yields are high, mortgage rates are high. Bond yields are affected by inflation in a few ways. As interest rates rise in response to the Federal Reserve trying to slow inflationary pressures, new bonds are issued with higher yields, making older bonds with lower yields less attractive to investors. Additionally, inflation can lead to a decrease in the purchasing power of the fixed interest payments and principal repayment of a bond, which can decrease the value of the bond overall. Overall inflation can be a negative factor for the value of a mortgage bond. Mortgage rates are also tied to broader interest rates, which are influenced by the overall state of the economy and the monetary policy set by the Federal Reserve, which meets every 6 weeks. When the economy is strong and inflation is rising, the Federal Reserve may raise short-term interest rates to keep inflation in check, which can lead to higher mortgage rates. Conversely, when the economy is weak and inflation is low, the Fed may lower short-term rates, which can lead to lower mortgage rates. In a nutshell, inflation is the arch enemy of mortgage rates. Low inflation drives low mortgage rates. High inflation drives higher mortgage rates. Finally, factor number 4 is lender profits. Lender profit margins are the final factor discussed here and can vary widely depending upon the lender's business model, the competitive landscape, and the overall economic conditions. The greater the expenses a lender has, such as employee salaries, marketing costs, and technology expenses, the greater the revenues needed to pay both those expenses as well as the profit margin that's desired by the lender. If you have any questions on mortgage rates and how they're determined, or any question in general regarding mortgages, we'd love to hear from you. I'm Russ Williams. Have a great year.